My name is Margaret Campbell, and I have to ask you a question that might feel uncomfortable. Are you and your spouse leaving thousands of dollars on the table every year? Because for a shocking number of Canadian couples, the answer is yes. There is a critical, widespread mistake involving how you receive your Canada Pension Plan benefits, and it's not something Service Canada will ever call you to correct. It's a silent drain on your retirement income, a slow leak that could be siphoning off $2, $3, or even $4,000 a year from your bank account without you ever noticing. It's hidden in the fine print of a provision called pension sharing, a powerful tool that most people either don't know exists or assume is being applied automatically. It is not. This isn't about finding a loophole. It's about stopping a loss of money that is rightfully yours after a lifetime of work. If you're a couple like Margaret and David, my friends from Nanaimo, hardworking people who paid into the system their whole lives and now rely on CPP and OAS, this message is for you. The feeling you might have right now, that small knot of anxiety in your stomach, is exactly why I'm here. This isn't an investment scheme or a complex financial product. This is about securing the full legal pension you earned. In the next few minutes, I will walk you through this bureaucratic maze, step by step. I'm going to show you exactly how to diagnose if this mistake is affecting your family, the specific forms you need to correct it, and how to safeguard your other benefits in the process. What you learn today could fundamentally change your financial security in retirement, putting that money back where it belongs, in your pocket. So please, stay with me. This is too important to ignore. For over 20 years, my work has centered on one thing: helping Canadian seniors navigate the incredibly complex and often unforgiving world of government benefits. I am a retirement planning consultant, specializing in the very systems that are meant to support you: the CPP, Old Age Security, and the GIS. I'm not an employee of the government. My loyalty is to you. I've spent my career inside this bureaucratic maze, deciphering the dense language of the Canada Revenue Agency and the procedural hurdles of Service Canada. I have seen firsthand how easy it is for good, honest people to lose out on what they're owed, not through any fault of their own, but because the system is designed in a way that is confusing and passive. It won't reach out to help you. My purpose is to bridge that gap and act as your personal advocate, ensuring that the lifetime of contributions you've made pays you back fully without a single dollar left behind. Think of me as your financial guardian. My mission is to translate the mountain of government jargon into simple, actionable steps that you can take to protect your money and secure your future. The system is full of these hidden trapdoors, like the pension sharing rule, that can cause your hard-earned retirement income to leak away silently. We are going to patch those leaks together. This channel is your resource, your shield against the complexity and inertia that cost retirees thousands. I am here to arm you with the knowledge that the system doesn't readily volunteer, so you can stand on solid financial ground, maintain your independence, and have the peace of mind you so rightfully deserve. We will turn your anxiety into action and your confusion into clarity. Let's begin. In today's video, I'm going to give you a clear 3-step map to navigate this process and secure the money that is rightfully yours. First, I'll show you exactly how to find and read your own CPP statement of contributions and your current payment statement to diagnose if you and your spouse are making this costly mistake. You will learn precisely where to look and what the figures actually mean, taking all the guesswork out of it. Second, we will tackle the bureaucracy head-on. I will guide you through the official Service Canada application for pension sharing, Form ISP-1002, explaining the critical boxes you must fill out correctly to get your application approved without frustrating delays. Finally, and this is the step that protects your overall financial picture, I'll explain how this change can impact your spouse's old age security and potential GIS eligibility, and the simple strategy to ensure this results in a pure financial gain for your household, not a surprise tax bill or benefit clawback from the CRA. This knowledge is your key to unlocking what you're owed, but the government can change the locks. Forms get updated, tax brackets shift, and eligibility rules are tweaked. To guarantee you never miss a critical update that could impact your retirement income, I need you to take one small action right now before we go any further. Please click the subscribe button below and ring that notification bell. Think of it as your personal alert system, a simple click that ensures you are always at the front of the line for vital financial information. It costs nothing, but missing a single update could cost you thousands. Now that you've set up your own financial defense system against being left in the dark, let's get that money back where it belongs. Grab a copy of your latest benefit statement if you can, and let's begin with Step 1. All right, let's begin with Step 1, diagnosing the problem. The core issue lies in a powerful but overlooked provision of the Canada Pension Plan called pension sharing. This allows a couple, married or common law, to share the CPP retirement pensions they earned while they were living together. Essentially, you pool the CPP contributions you both made during your shared years, and each of you receives an equal share of the benefit that was earned during that time. The crucial thing to understand is this is not automatic. Service Canada assumes you want to receive your own individual pensions unless you specifically apply to share them. This is where the money starts to leak away, especially in families where one spouse earned significantly more than the other. Because our tax system is progressive, splitting the income can often lower the higher-earning spouse's income out of a higher tax bracket, resulting in a lower overall tax bill for the couple. This means more after-tax money in your household account each and every month. To see if this applies to you, you need to compare your and your spouse's CPP entitlements. The easiest way is for both of you to log into your My Service Canada account online and look at your current CPP payment amounts. If you don't use the online service, your annual CPP statements will have this information. Let's take our example couple, David and Margaret from Nanaimo. David, the retired mill worker, contributed the maximum to CPP for most of his career and now receives a pension of $1,250 per month. Margaret, who worked part-time while raising their children, receives just $400 per month. Their combined CPP income is $1,650. David's higher income places his pension dollars into a higher marginal tax bracket than Margaret's. By applying for pension sharing, they could effectively average their CPP income. Instead of David receiving $1,250 and Margaret $400, they could each receive $825. While their total pre-tax income remains the same, their after-tax income would increase significantly. For David and Margaret, this simple administrative change could put an extra $2,000 to $3,000 back in their pockets each year. That's money for rising grocery bills, for a trip to see the grandkids, or simply for the peace of mind that comes with a stronger financial cushion. David's income is lowered, reducing his tax burden, and while Margaret's taxable income increases, it remains within a much lower tax bracket, creating a net tax savings for the couple. This is the leaky pipe I'm talking about, a silent drain of thousands of dollars year after year, simply because nobody told you to turn off the tap. Now that you can see the potential gain, the next question is how to claim it. The key is a single government form, ISP-1002, but it has pitfalls that can cause your application to be rejected or delayed for months. So, in the next step, I will walk you through that form, box by box, to ensure you get it right the very first time. So, you've identified the leak. Now it's time to call the plumber, which in this case means becoming the plumber yourself. The tool for the job is Form ISP-1002, the application for pension sharing. You can find it on the Government of Canada's website or request a copy from Service Canada. But I must be blunt. This form is where good intentions go to die in bureaucratic limbo. This is the very heart of the passive system I keep talking about. They provide the form, but they offer zero proactive guidance, and they expect absolute perfection. The single most common error is simple but fatal: incomplete or inconsistent information. A missing social insurance number, A date of marriage that doesn't exactly match official records, or a signature in the wrong place, will get your application mailed right back to you, often 2 or 3 months later, with a vague rejection note. That's 3 more months of lost pension income, all because of a small oversight the system was designed to punish, not to help you correct. Let's drill down into the form itself, specifically Section D, Period to be shared. This is the section that trips up most people. It asks for the dates you and your spouse or common law partner started living together. This is not just a formality. These dates define your joint contributory period, which is the precise time frame the government uses to calculate the portion of your CPP that is eligible for sharing. For David and Margaret, it's not just their date of marriage. They lived together as common law partners for 3 years before getting married. Those 3 years absolutely count, and including them could add thousands of dollars to their shareable pension amount over their lifetime. Missing those dates means you are voluntarily choosing to share less money than you are legally entitled to. The system will not question it or point out your mistake. It will simply process what you have written, leaving that extra money forever locked away. You must be meticulous here. Check your records and be precise. Finally, we arrive at the most critical step, which is so simple, it's often overlooked. Consent. At the end of the form, in Section F, there are signature boxes for both you and your spouse. Both signatures are mandatory. One person cannot unilaterally decide to share their pension. This is a joint legal declaration. An application with a missing signature isn't just delayed, it's dead on arrival. It will be rejected immediately. This signature requirement forces a conversation that every retired couple should be having. It's a moment to sit down together, look at the numbers, and make a conscious, unified decision to manage your joint retirement income more effectively. It transforms you from passive recipients of whatever the government decides to send you into active managers of your own financial destiny. It's a small act of paperwork that represents a massive shift in control. Now that we've sealed the leak, we must ensure this doesn't cause a new problem somewhere else, specifically with your old age security. That's our final, crucial step. Now we arrive at the most important part of this entire strategy, the step that ensures this change is a pure financial win for your family. It's about protecting your other benefits, specifically Old Age Security, OAS, and the Guaranteed Income Supplement, GIS. The government's financial systems are interconnected. A change in one area can trigger an unexpected reaction in another. When you share your CPP, the higher earning spouse's income goes down, which is good. But the lower earning spouse's income goes up. If that increase pushes their individual net income over a specific threshold, which is about $93,454 based on your 2025 income, affecting payments from July 2026 through June 2027, they will have to start paying back some of their OAS. This is the dreaded OAS clawback. For those with very low incomes, the increase could also reduce or eliminate their GIS payments. This is the final trapdoor the system lays for you. Without knowing this, you could fix one problem only to create another, which is exactly the kind of vulnerability and loss of control we are here to prevent. Let's go back to David and Margaret. After sharing their pensions, David's annual CPP income drops by $5,100, moving him much further away from the OAS clawback threshold and saving him a significant amount in taxes. That's a clear victory. However, Margaret's annual income from CPP increases by that same $5,100. Let's say she was previously receiving a small GIS payment because her income was very low. This new income will likely reduce or eliminate that GIS. This is where you must do the math. In their case, the tax savings David gains, combined with the fact that he is now completely safe from any OAS clawback, far outweighs the small amount of GIS Margaret will lose. Their household's total after-tax income still goes up by over $2,000 a year. Without doing this analysis, they might see the reduced GIS payment and panic, thinking they made a mistake. But by looking at the entire picture, they see it's a calculated strategic move that results in a significant net gain. They have taken control. So here is your single most important, actionable tip before you mail that ISP-1002 form. Do a what-if projection. You don't need a fancy accountant. You can use any free Canadian tax software. Create 2 draft scenarios. First, input your current incomes as they are today. See the final tax bill and after-tax income for your household. Then, create a second scenario where you adjust the CPP income for both you and your spouse to the new shared amounts. See how it affects not only your income taxes, but also the estimated OAS and GIS calculations that the software provides. Compare the bottom line, total household cash in your pocket between the 2 scenarios. This simple exercise, which might take you an hour on a Saturday morning, is the ultimate act of financial empowerment. It replaces fear and uncertainty with hard numbers and absolute clarity, ensuring that when you make this change, you are doing so with the confidence of a CEO managing your own family's financial future. So let's bring it all together. Today, you've learned the 3 critical steps to stop your hard-earned pension from silently leaking away. First, you learned how to diagnose the problem by comparing your and your spouse's CPP payment statements to see if you're leaving money on the table. Second, you now know how to navigate the bureaucratic maze of Form ISP-1002, paying close attention to the details that will get your application for pension sharing approved. And finally, you have the crucial strategy to protect your other benefits by running a simple what-if tax scenario, ensuring that this change results in a pure net gain for your household without any nasty surprises from the OAS clawback. This journey from confusion to clarity gives you the power to take what is rightfully yours. You are no longer at the mercy of a passive system. You are the active manager of your financial future. This knowledge is your shield, but the financial landscape for retirees is constantly changing. Government rules are updated, tax thresholds shift, and new benefits become available. My mission is to be your vigilant guardian through it all, to ensure you never miss a crucial piece of information that could protect your savings and your family's legacy. Please take one final action. Like this video and subscribe to the channel. Every like helps this vital content reach another senior who needs it, and subscribing ensures you are always first in line for updates. You've worked your entire life for this security. Don't let a single dollar of it slip away due to a lack of information. Thank you for your time and your trust. Protect what you've earned.